What if I told you that there is a completely legal financial strategy that allows you to keep your CPP, your OAS, and your GIS payments growing untouched while living on borrowed money? And what if that strategy also means that when you pass away, your estate pays back the loan, and you never paid a single dollar of income tax on the wealth you used to fund your retirement? This is not a loophole. This is not a rumor. This is a real, documented, legal approach that financial planners in Canada have quietly used for decades. It is sometimes called the borrow until you die strategy, and while the Canada Revenue Agency cannot stop you from using it, they certainly do not advertise it. Today we are going to explain exactly how this strategy works, who it is best suited for, how it connects to your CPP, OAS, and GIS benefits in 2026, and most importantly, what you need to know before considering it. Stay right here. This could be one of the most important financial conversations you have ever had. Welcome back to MR.JACK, the channel where Canadian seniors get clear, honest, and reliable information about money, government benefits, and financial strategies that actually matter in real life. Today, we are covering a topic that is rarely discussed on mainstream financial channels and almost never explained in plain language for everyday Canadians. We are talking about the borrow until you die strategy, a legal tax planning approach that, when combined with your CPP, OAS, and GIS payments in 2026, could fundamentally change how you think about retirement income. Whether you have savings, investments, a home, or other assets, this video will explain the concept clearly, break down the 2026 benefit updates that make timing so important, and walk you through what to watch out for. Let's get started. Let's begin by understanding the core concept because the name can sound alarming at first, but the underlying logic is sound, and many Canadian financial advisors use variations of this approach regularly. The basic idea works like this. Instead of selling your investments, drawing down your RRSP, or cashing out assets to fund your retirement living costs, you borrow money, typically through a secured line of credit or a home equity line of credit, and you use those borrowed funds to cover your day-to-day expenses. Meanwhile, your investments or savings continue to grow untouched, and because borrowed money is not income, the Canada Revenue Agency cannot tax it. You spend the borrowed funds. You live your life. You do not sell your assets. You do not trigger capital gains. You do not push yourself into a higher income tax bracket. And your government benefit payments, your CPP, your OAS, and your GIS continue to arrive in your account every month exactly as scheduled. When you eventually pass away, your estate settles the loan using the assets that have been growing throughout your retirement. If those assets, whether they are investments, a property, or other holdings, have grown more than the interest on the loan, your estate comes out ahead. And crucially, the assets can often be transferred or liquidated in a tax-efficient way at that stage. Now, this is not a strategy that is right for every person in every situation. It requires assets, careful planning, and ideally the guidance of a qualified financial advisor or accountant. But for seniors who have savings, equity in a home, or non-registered investments, understanding this approach is genuinely valuable. And here is the key connection to your government benefits. Because you are not selling assets or converting savings into income, your taxable income remains lower. A lower taxable income means you are better positioned to retain your full OAS payment without triggering the recovery tax clawback. It means you are more likely to remain eligible for GIS if your income is near the threshold, and it means that your CPP, which you have already earned, is not being offset by a higher income position that could affect other means-tested benefits. In plain terms, when your income on paper stays low, the government programs designed for lower-income seniors remain available to you, even if your real-world wealth is significantly greater. This is the part that many people find surprising. Under the Income Tax Act of Canada, borrowed money is not considered income. When you take out a loan, a line of credit, or a mortgage advance, that money does not appear on your tax return as taxable income. You are not required to declare it, and the CRA cannot tax it, because it is a liability, not a gain. This is a fundamental feature of how taxation works in Canada, and it applies to every person, including seniors. If you borrow $50,000 from your bank using your home equity, that $50,000 is not income. You can spend it on groceries, travel, home renovations, medical expenses, or daily living costs. and none of it is reported to the CRA as taxable income. Compare that to the alternative. If you sell $50,000 worth of investments, you trigger a taxable event. Depending on the type of investment and when you bought it, you may owe capital gains tax on a portion of that sale. If you withdraw $50,000 from an RRSP or RRIF, that amount is added to your income for the year, potentially pushing you into a higher tax bracket, reducing your GIS payment, or triggering the OAS clawback. The difference between borrowing and selling or withdrawing is the difference between a tax event and no tax event. That distinction is not something the CRA created to be unfair. It is simply how the system works. But very few seniors are aware of it, and even fewer have been shown how to use it strategically. Now, the interest on your borrowed funds is not automatically tax deductible. However, if the borrowed money is used to earn income from investments, for example, if you borrow to invest in dividend-paying securities, the interest may be deductible under Canadian tax law. This is a more advanced application of the strategy, and it requires professional advice. But it illustrates that the framework of using borrowed capital in retirement has multiple layers of potential tax efficiency built into it. Now let's look at your CPP in the context of this strategy and what has changed for 2026 that every senior needs to know. The Canada Pension Plan continues to be the foundation of retirement income for most Canadians who worked and contributed during their careers. For 2026, CPP payments have been adjusted upward based on the Consumer Price Index. This annual cost of living adjustment ensures that your CPP retains its purchasing power as prices rise. The maximum CPP retirement pension for a new recipient beginning at age 65 has increased in 2026. Most Canadians receive an amount below the maximum, but everyone who receives CPP has seen their payment indexed upward this year. This applies whether you started collecting early at 65 or delayed to age 70. For those who delayed their CPP, particularly those who waited until 70, the combination of the enhanced deferred amount plus the 2026 cost of living increase means a significantly higher monthly payment. Delaying CPP remains one of the most financially powerful decisions a Canadian senior can make, and in 2026, that strategy continues to pay off handsomely. Now, here is where the borrow until you die strategy intersects directly with CPP timing. Many seniors feel pressure to take CPP at 60 or 65 because they need the income to live on. But if you have home equity or other assets that allow you to borrow modestly to fund living expenses in your early retirement years, you can delay your CPP, growing that benefit significantly, and then begin collecting a much larger monthly amount later. The borrowed funds bridge the gap, and your CPP, when it starts, becomes a larger, inflation-protected, lifetime income stream. This is not theoretical. This is a strategy that financial planners actively discuss with clients who have the assets to support it. The key requirement is having something, a home, investments, savings, that secures the borrowing and eventually repays it. CPP payment dates in 2026 continue on the regular monthly schedule, deposited on the third to last business day of each month. If you are already receiving CPP, make sure your banking information with Service Canada is current so that every payment arrives without interruption. Old age security is where the borrow until you die strategy becomes especially powerful and where the connection to taxable income is most direct. For 2026, OAS payments have been adjusted quarterly in line with the Consumer Price Index. The base OAS amount for recipients aged 65 to 74 has increased. For Canadians aged 75 and over, the automatic top-up introduced in previous years remains in effect, resulting in a higher OAS payment than for the younger senior category. Both groups have seen their payments adjusted for 2026. Now let's talk about the OAS recovery tax, commonly called the clawback. This is one of the most significant threats to the OAS income of moderate to higher income seniors, and it is directly connected to your taxable income. The clawback works like this. Once your net income from all sources exceeds a certain threshold, a threshold that is updated annually, you are required to repay a portion of your OAS through your income tax return. The more your income exceeds that threshold, the more you repay. In some cases, very high-income seniors repay their entire OAS benefit. For 2026, the income threshold at which the clawback begins has been updated. If your net income from taxable sources exceeds this level, your OAS benefit begins to be reduced. This is reported on your T1 tax return and is calculated by the CRA based on your previous year's income. Here is the critical point. Borrowed money does not count as income. So a senior who borrows funds to cover living expenses rather than drawing down registered savings or selling investments keeps their net taxable income lower. A lower net income means the clawback either does not apply or applies at a reduced level. That can mean thousands of dollars of OAS preserved each year. For a senior receiving the full OAS and approaching the clawback threshold, maintaining income discipline through a borrowing strategy is not aggressive tax planning. It is simply an awareness of how the system works, and a choice to structure your finances in a way that protects the benefits you are legally entitled to receive. One important reminder, OAS is not automatic. You must apply for it. If you are approaching 65 or have recently turned 65 and have not yet applied, please do so through my Service Canada account or by contacting Service Canada directly. Do not assume the government will simply begin sending your payment. The Guaranteed Income Supplement is the most income-sensitive of all three government benefits, and it is the program where thoughtful management of your taxable income can have the greatest financial impact. The GIS is a monthly, non-taxable benefit available to OAS recipients with low income. For 2026, GIS amounts have been adjusted quarterly to reflect changes in the cost of living. The GIS is particularly valuable for lower-income seniors because it can add hundreds of dollars per month to their income, completely tax-free. But here is the challenge. GIS eligibility is determined almost entirely by your taxable income from the previous year's tax return, and the threshold for GIS is not particularly high. Even a modest pension withdrawal, a part-time income, or an investment sale can push a senior's reported income above the GIS eligibility line, reducing or eliminating this benefit entirely. This is where the strategy of managing how you generate income becomes extremely important for lower-income seniors. If you have a small RRSP or RRIF that you are drawing from, the withdrawals count as taxable income. If you sell investments, the capital gains count as income. If you receive rental income, that counts. All of these sources can affect your GIS. But borrowed money does not count, so a senior who is near the GIS threshold has a genuine financial incentive to consider whether there is a way to meet their short-term cash needs through borrowing rather than through taxable withdrawals, if that is available to them. Of course, not every senior has assets available to borrow against. The GIS is specifically designed for seniors with limited income and limited assets. If you do not own a home with equity or do not have investments to secure a line of credit, this specific application of the strategy may not be available to you. But for seniors who are on the borderline, perhaps you have a small amount of home equity or modest non-registered savings, understanding the income implications of how you draw from those resources can make a meaningful difference to your GIS payment. For 2026, the income thresholds for GIS have been updated. The exact figures are published by Service Canada and can be found on the Government of Canada website. It is always worth checking your eligibility if your financial situation has changed or if you have never applied. Retroactive GIS payments are available in some circumstances for up to 11 months, so do not delay if you believe you may have been entitled and missed out. And as always, file your income tax return every year. GIS eligibility cannot be assessed by Service Canada if you have not filed. Even if you have no income to report, filing your return is essential to maintaining access to this benefit. For many Canadian seniors, the most accessible source of borrowing is the equity in their home. Canada's housing market has meant that a significant number of seniors own properties that have increased substantially in value over the years. That equity, the difference between what your home is worth and what you owe on it, can often be accessed through a home equity line of credit, commonly called a HELOC. A HELOC allows you to borrow against the value of your home at relatively low interest rates, and it is flexible. You borrow what you need when you need it, and you only pay interest on what you have drawn. You are not required to sell your home. You continue to live in it, and the available credit can serve as a reserve that supplements your CPP, OAS, and GIS income without adding to your taxable income. Now, a word of caution. A HELOC is a debt. It must be repaid either by you during your lifetime or by your estate after your passing. If your home value declines or if interest rates rise significantly, the cost of maintaining that debt increases. A HELOC should never be used carelessly, and it is not suitable for every senior in every situation. However, for seniors who have substantial home equity, a low level of existing debt, and a clear plan for how the loan will be repaid, whether through the eventual sale of the home, through life insurance, or through other estate assets, a HELOC can be a thoughtful and tax-efficient tool for managing retirement income. The key distinction is purpose and planning. Using a HELOC to fund a lifestyle beyond your means, or without any plan for repayment, is a financial risk. Using a HELOC strategically and carefully to bridge a gap, preserve taxable income thresholds, or delay the drawdown of appreciating assets is a fundamentally different conversation. This is why professional advice is so important. A qualified financial planner or tax accountant who understands both your personal situation and the current 2026 benefit environment can help you determine whether this kind of approach makes sense for you and how to implement it safely. Let's bring this to life with a realistic example. Not a specific person, but a representative scenario that illustrates how these pieces fit together. Imagine a 68-year-old Canadian woman. She is a widow. She owns her home outright. It is worth approximately $400,000. She has a small, non-registered investment account worth about $80,000. She receives OAS and a modest CPP of roughly $900 per month combined. Her income is low enough that she currently qualifies for a partial GIS payment. She needs about $30,000 per year to live comfortably. Her CPP and OAS together cover roughly $20,000 of that. The remaining $10,000 needs to come from somewhere. Option A, she withdraws $10,000 from her investment account each year. This triggers a capital gain, and the gain is added to her taxable income. Over several years, this reduces her GIS payment, costing her hundreds of dollars per month in lost benefits. Option B, she sets up a HELOC against her home and draws $10,000 from it annually. This money is not income. Her taxable income stays the same. Her GIS is preserved. Her investment account continues to grow. And when she eventually sells her home or passes away, the estate repays the HELOC from the proceeds. In this scenario, option B results in a meaningfully better financial outcome, not because she did anything complicated, but simply because she understood the difference between taxable income and borrowed money. This kind of scenario plays out across Canada every day, and the seniors who benefit most are the ones who take the time to understand how the rules work and who seek professional guidance on how to apply those rules to their own situation. The borrow until you die concept is real, legal, and used by many Canadians. But it is not a do-it-yourself approach. The tax rules surrounding income, borrowing, investment gains, and benefit eligibility are complex, and making a mistake can cost you money rather than saving it. This video is educational in nature. It explains concepts and provides general information. It is not personalized financial advice, and it should not be treated as such. Every person's situation is different, and the right strategy for you depends on your specific income, assets, family situation, and financial goals. If your net income is approaching the OAS recovery tax threshold, now is the time to review your income sources carefully with a tax professional. Even a modest change in how you access money, shifting from a taxable withdrawal to a non-taxable borrowing, could preserve your full OAS payment for the year. We cannot say this often enough. If you receive GIS, or if you believe you may be eligible for GIS, you must file your income tax return every single year. Service Canada uses your most recent tax return to assess your GIS eligibility and calculate your payment amount. Any strategy involving borrowing must account for the cost of that borrowing. Interest rates in Canada have fluctuated in recent years. Before setting up a HELOC or line of credit as part of a retirement income strategy, understand the current rate, whether it is variable or fixed, and how a rate change would affect your monthly carrying cost. Unfortunately, as conversations about retirement income strategies become more common online, scammers are also becoming more sophisticated. Be extremely cautious of anyone who approaches you by phone, email, social media, or in person, claiming to offer a secret tax strategy, a guaranteed investment, or a special loan program for seniors. Let's bring everything together and summarize what we have covered today. The borrow until you die strategy is a real legal financial planning concept used by many Canadians. At its core, it is built on one simple truth: borrowed money is not income, and the Canada Revenue Agency cannot tax it. By using secured borrowing, such as a home equity line of credit, to cover living expenses instead of selling assets or making taxable withdrawals, seniors can keep their taxable income lower, preserve their government benefits, and allow their investments or assets to continue growing. For 2026, this strategy is particularly relevant because all three major senior benefit programs have been updated. CPP payments have been indexed upward with the cost of living adjustment, and delaying CPP remains one of the most powerful financial decisions available to Canadian seniors. OAS has been adjusted quarterly, and the clawback threshold has been updated, meaning that income management continues to matter enormously for those near the threshold. GIS remains the most income-sensitive of all three programs, and for eligible seniors, every dollar of unnecessary taxable income can translate directly into a reduction of this vital tax-free benefit. The connection between these programs and smart income planning is real, and understanding how borrowed money fits into that picture gives you a genuine tool, one that is available to anyone with the right assets and the right professional guidance. What should you do next? First, review your current income sources and understand which ones are taxable and which are not. Second, if you own a home with equity or have other assets, speak with a qualified financial advisor about whether a borrowing strategy makes sense in your situation. Third, make sure your Service Canada information is current, your taxes are filed, and your banking details are accurate so that every CPP, OAS, and GIS payment reaches you on time. And fourth, keep watching MR.JACK. Because every week we are here to give you the clear, honest, and practical information that helps you protect your income, understand your rights, and make the most of your retirement. If today's video gave you something valuable to think about, please take a moment to give it a thumbs up. It helps other Canadian seniors find this information when they need it. Share this video with someone you know who is navigating retirement income decisions. And if you have not already, subscribe to MR.JACK and turn on the bell notification so you never miss a video. You have worked hard your entire life to build what you have. You deserve clear information, fair access to your benefits, and a retirement that is as financially secure and stress-free as possible. That is what MR.JACK is here for. Thank you for watching. Take care of yourself, and we will see you in the next video.